What is up, everybody? Welcome to Money Market Truth. I am Mark, and this is my co-host.
Hi, guys. This is Mo from OTB Clubhouse.
There's always a little delay with you, Mo, every single time. It's like you forget that when I say co-host, it's supposed to be you. What's going on, everybody? Hopefully, you guys had a wonderful week in the market when it comes to trading and investing, but we're going to get into this here in a little bit. But without further ado, we do have a guest here today, so I'm not going to waste too much time. We're going to cover one topic today real quick, a topic that was announced here a few hours ago. We're shooting this today on Sunday, so we're going to cover this real quick, and then we're going to get into our guests. First of all, if you guys remember, about 2 weeks ago, we covered the CHIPS Act. I was telling you guys and informing you on the reason why the chip sector was basically declining at that point, because there was a bill that was presented back during the Trump era, and it hasn't been funded yet. The Senate passed it, the Congress passed it, but now it's being held up. And the reason why is both the House and the Senate both had their own version of it, so they have to reconcile the bill and they have to put it in one. But the problem is, as typical here in the United States, when it comes to anything, nothing can get done without people agreeing with one another. And the problem is both sides don't agree. And because of that, we have, the Senate Majority Leader Chuck Schumer. He tried to add additional drug price reductions and tax increase on the wealthy. He was trying to put that in the bill, and Mitch McConnell said, no, we're not going to add that to the bill. So if you're unfamiliar with how a lot of bills pass, is when you have an idea, for example, we're using CHIPS Act as an example. You want to pass that bill, but then someone will say, okay, cool, I'll pass this bill, but I want to put women's rights in there when it comes to abortion. And then it ends up being this whole complicated situation where they're like, no, we're not going to add this into the bill, and then nothing ever gets passed. That's basically what's happening with the CHIPS Act right now, and that's the reason why it wasn't funded. But we got some breaking news today. Once again, the greatest investor of all time, Nancy Pelosi. Yes, sir. Her husband apparently bought $1 million worth in the computer chip stock right before the big subsidy vote, because they're going to be voting it again here shortly to see if they can pass it. They actually want to take it away from the bill that was currently in place and come up with an idea to basically get it passed right before recess. And of course, you know, Nancy Pelosi is the greatest investor of all time. When her husband starts buying shares into something, it's very likely that this will get passed. So I know 2 weeks ago we said that at least I said, in my opinion, I don't think that this bill is going to get passed anytime soon, because it doesn't seem like Congress or anybody's really paying attention to it. But, you know, Nancy Pelosi her husband bought millions of dollars worth in stocks like NVDA and et cetera. So now it looks like this bill may actually get passed here soon, which will free up $52 billion in American companies investing into the semiconductor business here in the United States, but it also is open up to foreign investors as well. What's your thoughts on this, Mo?
So you're correct. The bill's getting voted on Tuesday. I have the figures. They're from Unusual Wheel. Pelosi's husband disclosed 20 million in stocks and 5 million in options. And I don't know the exact options he bought, but we're going to find that out pretty soon. Probably comes out on Monday. Yeah,
but we also got to remember that a lot of information, typically when they file that stuff, it's kind of delayed. So we don't really know if he's still holding these shares or not, or these option calls or puts or whatever he had. We don't know if he's still holding it right now. So this information is a little bit delayed, correct?
So based on the information, he's still holding it. He still has the stocks and the options. Now, Martha Stewart went to jail for 6 months, right?
I think it was longer than that. I think it was way longer than 6 months.
I think she stayed. I read all of this stuff on Unusual Whales, but Pelosi, this is his 6th or 7th time doing this, having information and just buying stuff beforehand. I'm glad we're covering this stuff, because everyone knows about the bill, but no one really knows what goes in the back. And Unusual Whales has been talking about it a lot of times, but they're finally getting media coverage and what's happening. And it's pretty bad.
Yeah, I think personally that's considered insider trading, in my personal opinion. But, you know, when you're a government official, the rules don't really apply to you. But, you know, just keep an eye on what Nancy Pelosi always does. Technically, it's not Nancy Pelosi, it's her husband. I think that's how she gets away with it, because technically she can't really do it, but her husband can. So We'll see. Of course, when it's time for her to get out of office, I'm sure they'll probably vote or pass a bill which will stop Congress and senators from investing in themselves, you know, because now she's no longer in that business. So we'll see what happens. Another thing I want to touch on real quick before we bring on our guest, and I may cover this with our guest here, but a couple of weeks ago, I gave my opinion on Palantir because I am a Palantir bear, and I got a lot of hate. Yo, I'm saying that this is like, we did like a little clip from it, and a lot of people viewed it, and I got a lot of hate. So I'm going to get into this a little bit later. If not today, we're going to do this next episode because I have some additional information on the reason why I'm a bear. And but we have a Wall Street individual here. He is a corporate investing banker on Wall Street. So ladies and gentlemen, give a round of applause for our guest, our very first guest at that. His name is Q. Welcome, Q. What is up, man? How are you doing?
What's good, fellas? I'm doing well, man. How are you?
I'm doing well, man. Thank you for coming on. Yeah, thank you for coming. We've got a lot of questions for you, mostly Mo. Now, anytime, man. This is always great having you on here, man. So if you guys are unfamiliar, Q, he's been on the Come Up series a few times. He works on Wall Street. He's actually one of my personal friends. So he's got a lot of information. I learned a lot from him. Literally, like majority of my investment thesis has come from this guy. He's taught me so much. So I appreciate that. And that's why we thought it would be a great opportunity to bring him on this show. We have an actual person who has licenses. Yes, because as you guys know, I'm unlicensed. Mo is unlicensed. I'm just a real retail investor. Mo is a trader. This guy right here, he's the real deal. So Mo, what do you got for him, man? Ask him the hard stuff.
So before we get in, like just how I got to know Q was, I was watching a YouTube podcast and Q popped in and he talked about how funds rebalance and how, if you look at the end of the month, sometimes back in 2020, the last 3-4 days, we would always see tech selling and money moving in. And Q talked about how that happened and why that happened. And before that, I never heard about it because most of the information I was consuming was from retail investors that usually talks about buying Apple, Microsoft, and Google, right? So I'm glad Q is here because I speak to a lot of people when it comes to trading, but when it comes to investing, I don't think I've met anyone better that can break down fundamentals and technicals and tell you what he thinks his bias and what happens if the bias doesn't go through. So it's not like buy Apple blindly, become a millionaire after 10 years. So Q's got that unbiased view because he understands the business very well. And I remember your thesis on Chipotle. I don't think you know that. I think this was like a couple years ago when everyone was bearish on Chipotle and you had your own thesis. And that's one thing Warren Buffett talks about. If you can't hold your own opinion, and then you're not an investor, because the moment your guru's or your mentor's opinion changes, you're going to change opinion as well. Yeah. So Q, my first question to you is how are funds or how are institutions managing buying and selling stocks in this environment?
I think it matters to the fund, right? So I think like I started at a 30,000 foot view, right? So what does Earth look like from space? And then if we use the Google camera and we zoom in to what a country looks like, then to what a city looks like, then to what a town looks like, and then to what a street, and then what a home looks like, you can see somebody's home on the Google camera, right? So I think when you look at, okay, you have fund managers. So let's start with institutions that are asset managers, right? You have a large cap growth fund, mid cap growth fund, large cap core, S&P fund. You have an SP 500 fund. You have international fund, right? So it matters to the person that's running that fund. There's no one size fits all. If you're a value investor, right, you're having a great time in the market. You may have not had a great time in the last 10 years in the market, but this market, the stocks that you liked or maybe were really bullish on have done well. If you're a high growth tech PM, you may have a hard time in this market because some of the names that have worked for you for the last 10 years haven't worked. So I think you start there, right? Who is the fund? What is the fund? What's their objective? And then you kind of build out your idea from there. So I think everybody's approaching it. I always say it's an ocean, right? A fish, a shark, a dolphin, a whale all live in the sea, but they all have different missions or different things they need to accomplish on a day-to-day. Right. So I look at it from that perspective. So a fund manager that's running a value book, right? He's looking at PE ratios and saying, okay, how much more can I get? Or where are the other undervalued names in my sector that I cover? Right. So even deeper, it could be just a consumer fund. It could be a healthcare fund, right? It could be just strictly a sector. Right. And so when I'm looking at that, they're trying to figure out where's my advantage, right? What can I scale off of to take advantage of? So if, let's say I own Dollar Tree and Iran, right? Now I got some profits. Where can I put those profits to kind of get the same return somewhere else that's maybe not acknowledged, right? And that's kind of like the thought process that we have, right? What idea is not being acknowledged that will be acknowledged, right? Because if you have an idea, it doesn't matter that your idea is good or that anything makes sense to you if the market refuses to acknowledge it. The same way, let's say in basketball, Kareem Abdul-Jabbar is the top 3 player all time if we're just talking resumes. His name never gets brought up. So if you're buying his stock with the idea that he'll be a top 3 conversation piece, right, amongst casual fans, not hardcore fans, then you're buying the stock too high. He'll be a top 10 name. So if I'm buying it at the price of him being a top 10 name, I love that value I'm getting because he's a sneaky value when we start talking about resumes. But if I bought it and I said, okay, best basketball players, LeBron, Jordan, Kobe come up automatically, right? Then Magic, Bird, different people, we never really hear his name, right? Well, what's the bias? Well, the bias is that he's a 7-foot Muslim. That's not relatable. So people aren't going to attach themselves to somebody who's a 7th Muslim, but you can't take away from his resume. So he's in the top 10, but he'll probably never be in the top 5 or 3 of the convo, not based on what he's done, but based on the bias of the crowd that's judging who it is, right? Isn't it the stock market in the same way?
Yeah, agreed.
Yeah, absolutely. My question for you though, real quick. So you're saying like with the investment and fund managers, right? They will buy into a company, and then when they decide that the market is not reflecting what their thesis is, they end up moving it somewhere else.
So you have guys that will say, all right, great business, right, but terrible performance based on what the market thinks sentiment-wise. Now you can double down and say, hey, I'm in it for the long term. So let's go back to the funds. What kind of fund are you? If you're a long-term asset manager, right, we call it a long only, you're invested for 3, 5, 7 years. So you're building a position. So those down days are opportunities for you to build your position, right? And so when we look at the market, let's take earnings, for example. We've all seen stocks trade up and down on earnings, right? The stock comes out with great earnings, the stock goes down. And I can't figure out why the stock is going down. Well, because there's algorithms or there's hedge funds or different people covering leverage, right? And so let's look at a hedge fund. A hedge fund, the biggest one might be what, $400 billion, right? As far as a hedge fund. And that's a lot of money until BlackRock walks in with $9.2 trillion of assets under management. So when earnings come out and different information comes out and news has come out, who do you think Tim Cook is calling? He's not calling the hedge funds, right, to talk to them. He's calling BlackRock and Asmundi and Capital Group and all the trillion-dollar hedge funds, Bank of New York Mellon, right, the guys that hold his stock, because the majority of the stocks that we love have 70, 80, 90% institutional ownership. So the retail portion of that stock is almost like someone jumping on top of the pile when there's a fumble in football. You're not really doing nothing, even though you think you're doing something, right? And so, like, that's where it matters at, right, with the manager. So what kind of fund am I running? What returns am I up against, right? So if I'm a tech guy, I'm probably down, right, based on the market. But comparable to my peers, that's where it matters, right? If my peers are all down worse than me and I'm only down 5%, I'm kind of okay. I can kind of buy and do different things. So we're still looking at the environment. I think we have to look at investing as an ecosystem, right? So I think like that's what I'm saying about fund managers. They understand the ecosystem. So if something's not working, depending on their time horizon, they may double down or they may scratch the idea to go somewhere else. That's going to be dependent upon what it is that they have to return at their shop, right? Whereas a retail investor, the majority of the time, the biggest problem is liquidity. It's not the idea. It is, I bought this stock with all my money. I'm 100% invested. The stock is now down 15%. I don't want to take a haircut. So now I have to hope it goes back up, because if it goes down 25% now I'm stuck with the name. I got to hold it, but I need liquidity because I have a mortgage, I have kids, I have other stuff. So the problem a lot of times for retail is not the idea, it's the liquidity. On the other side, for the fund manager, the problem has nothing to do with the liquidity. It has everything to do with the expectations of the fund in terms of what they're supposed to accomplish for their actual institution. So again, we're all in the ocean, but we're fighting two different wars.
Do you think the mindset with the retail investors are definitely somewhat skewed, where too many people are just focused on one sector and are not looking at various different sectors and understanding when to pivot, when not to pivot?
I think that majority of retail investors don't respect the process. I think that if we're going to break down something, like you know me, I'm very big on breaking down. Okay, let's break down a retail investor who's receiving information third or fourth hand from a person or institution or a publication or a media firm that they assume to be smarter than them, right? And they take that information as material and literal, right? Without doing any research or any fact, are competing against analysts and funds, right? So an analyst covers, let's say, software. Well, guess what? That guy spends 80 to 100 hours a week looking at software names. He knows everything. And not only does he look at the software names, he talks to the IR, the CEO, the CFO, the COO. He knows those companies in and out. And on top of that, he has a team full of 3 or 4 other guys that are juniors that know it just as well, where they split it up so they all know that area really well. They don't know anything about financials. They know nothing about industrials, but they know software really well, right? So you have those guys. And those are the guys giving instructions to the traders, right? So those are the guys handing out and say, hey, this is what I see, do this. Now you have John. John has a regular 9 to 5, 3 or 4 kids. How can he compete with that guy? Right? He doesn't respect the process. So rather than, hey, I'm going to paper trade, I'm going to find a way to put my money in some ETFs or something that's a little safe, I'm going to have a cash and take my time and inch my way into investing. What do? I get on the internet and I see a bunch of folks that are making money or supposedly making money, right? And now I want to get rich fast. I want to get this money, whether it's options, whether it's speculative stocks, whatever it is, and I jump in full bore, full throttle, and I go that way. I don't respect the process because everybody that you're competing against not only has more education, they have more money, they have more assets, right? They have everything more than you. So if I'm going to have to punch with you, I'm going to be selective in my punches. But most people come out of the other corner versus Mike Tyson, you're going to get knocked out, right? So I think that retail investors just don't have a respect for the process of becoming an investor, whether you're a trader, whether you're a swing trader, whether you're a scalper, whether you are a day trader, whatever it is that you do, you have to respect your process and your craft. I don't think most people do that because the returns will be better, the experience will be better, and it would force institutions to change their approach. But they don't have to because you know predictably how people will react on the other side.
I 100% agree with you on this because I've said that before. Like if I'm like a retailer, it doesn't matter if I have a 10,000, 100K or a million. If I'm an investor and I've invested all of my money, it's not that I don't think the market's going to go up or down. I don't have any more money. I can dollar cost average, but let's say I have 100K in my investment account and I'm down 50% because all I did was buy high growth, or down 30%. And let's say I make $5,000 a month and I have $1,000 disposable income. What is that $1,000 going to do to a 100K investment when stuff is going expensive, right? Groceries are more, mortgage is going up more, my tax remains the same, inflation's high, and I don't make any more money. So that's what I completely agree with you. I don't think people think that Square is not a good stock or Apple. It's just, what do you do? Like, you don't have any more money because you've invested everything.
I think, all right, so take an example, right? Financials just came out and Citi was up on Friday, right?
Yeah.
And Citi was up because their operating leverage, right, performed very well. And so when my net expenses are not going up, but my net profits are going up, right, I have operating leverage. And I think a lot of people operate reverse. They don't have operating leverage when they're trading. The expenses are going up. And even if your revenue is going up, a lot of times when I make more, I spend more, right? That's kind of how the American culture is. So I think when you look at companies, if you have an idea, right, I have to understand the business. Warren Buffett is really good at understanding the business of a stock and not what the market thinks. What the market thinks matters. But if I have a business that has something that I think the market will acknowledge in the long run or even in the short term. So he bought Citi, right? And a lot of people kind of like, well, why did he buy Citi? Well, because they're going to have operating leverage. And then you look at them and they're the second biggest or second best fixed income shop behind Goldman, right? They started to shutter some of their exposure to equity. So they're not as much hurt as other global money centers as everybody else in their kind of in their bracket because they're really good at fixed income. They have good operating leverage. They've been getting skinnier, getting rid of trimming certain things and fixing themselves. And they've turned the narrative around on the stock, right? Sentiment-wise. So they did a really good job. Does that make them better than Goldman or JP? No. But Goldman and JP have a lot more exposure. So understanding even how a company gets paid, right? So you have regional banks. Regional banks work on traditional deposits. They take in deposits, right? And then they lend the money out. That's why the Fed fund rate is important, because for a long time, I was able to borrow money for 0% interest, right? And then lend that money and, right, the whole functionality of how our economy works. So when you understand that and you understand rates are going up, sometimes it's not a signal that go by the money center banks that have global government merger and acquisitions, IPO, that kind of exposure where their business lines are hit by a rising interest rate as much as it is on the lending part helped. But to say, okay, PNC and US Bank and other traditional money managers that strictly make money off of lending, right? So understanding how a company gets paid to that point, a lot of retail investors don't even know that part. They're looking at Citi and thinking Citi, Goldman, JP, all in the same bucket. And it's like, no, everybody gets paid differently. Everybody makes money. Morgan Stanley is really good when it comes to merger acquisitions, IPOs, right? They get paid a lot of fees, and a lot of people aren't doing business in that area. So of course your business will be down, right? And so like that's natural, but I have to acknowledge that, and the market will acknowledge that when earnings comes. But a lot of folks miss Citi. Why? Because they didn't understand how Citi got paid, nor did they care, because the stock didn't have good sentiment. Just that fast, right? Stocks up the next day. If you had that wherewithal, you'd be able to take advantage of that, because it was free money to a certain extent, right? Prior to earnings, if you look at the company.
Awesome. Mark, any follow-up questions?
Yeah, I do have some, because you mentioned that Warren Buffett started buying Citi, right? Now, I keep track sometimes of his assets and what he's buying. And he's been investing in Bank of America for a while now. What's your thoughts on that now? Since Citi did well, what's your thoughts on Bank of America? Because I know probably a lot of retail investors now will probably believe, like you said, just because Citibank did well does not mean that Morgan Stanley or JP Morgan is going to do well, right? But I'm sure that a lot of people will see, oh, Citibank did well, which means that Bank of America is going to do well, JP is going to do well, everyone's going to do Visa, MasterCard, everyone's going to do well. But that's not necessarily the mindset you should have, correct?
Yeah, you want to look at the business. How do they get paid? Like what can they add? What do they need to add? Where are their strong points? Where are their weak points? All right, because everybody does something different. JP Morgan is best in class at everything. So, their stock hasn't performed like that because they spent a lot of money, right? Whether it was acquiring talent. Then on top of that, with banks, right, we have to keep in mind of the reserves they need to have on hand because of the 2008 crash. So the more likelihood that we have a recession, the more that they have to stick to these cap requirements. So when you look at it and you go, well, JP said they're going to stop buying back shares. XYZ is like, yeah, because I have to have this cap reserve and still do business. So we have to, again, to know all these things, you have to really zone in on a company or a sector and take your time to understand it. That's why if somebody tells me, yo, I know about 50 companies, I'm like, well, how do you have a job? You have a family, a life? Like, it takes a lot to really know these companies, because with Bank of America, really intriguing story, really intriguing company, right? As far as price, and I can see why Warren would like it. I can understand that they're positioned to do really well. They're very conservative, so they don't have a lot of outstanding risk. If they could just fix the fixables and do the right thing, the stock should perform. But past earnings, the stock didn't perform well. They had a good earnings. I think it was up like 18 cents the next day, whatever. And I think like some of that has to do with sentiment around the name. Some of that has to do with where we are economically. Some of that has to do with a lot of different parts. But when you break down this solid bank that I think is very well positioned, so I can understand that. I'm not a huge fan of the stock. I like Goldman, JP, PNC. I like some other names a little better if I had their rank out, stuff. Maybe Citi even moved ahead of them. But I understand why, and I don't have to be involved, right? That's another thing, retail investors. You don't have to be involved in everything. My mom used to say all the time, you don't have to dance every dance and go to every party. You just don't. You don't have to have FOMO. What's meant for you won't miss you.
So Q, I have a question for you. Let's just say I'm a new guy investor. I want to get in the market because everyone on Instagram is telling me that I'm going to become a millionaire if I start investing now.
Mm-hmm.
So the first question is, are we in recession or not? Second question is, what do you recommend if all I have is $10,000? How would you go about distributing those funds? Would you invest now? Would you dollar cost average? Or would you wait for the feds to change? Or do you have any other opinion?
I think on the recession front, it depends on who you ask. I think that that word gets thrown around very lightly. And I think, again, it's narrative. You have to understand the importance of your influence, right? So Bill Ackman understands the importance of his influence. So he'll go on TV, say something, and he's influential, and he'll be able to get a reaction from the market, right? So like when you're looking at something, how influential is my influence, or how important is my influence, right? I have to know that. So I think a recession thing is based on how you view the economy. I think like, all right, I don't necessarily think that we're in a recession, but I could be wrong. I think that we have strong data. I think we're in a really kind of funny time because some of the things that we're going through aren't our fault. So sometimes, most of the time when there's a recession, it's kind of our fault. I think there's a lot of extenuating factors that we didn't have on our bingo card. Didn't have a war, didn't have a pandemic on our bingo card. We didn't have a lot of stuff, just kind of the way it played out. So I think there's a lot more positive to where we are, but I can understand the other side. Again, two things. Just because I don't think it does not mean I don't understand it. I think that from a social media and communication standpoint, people are only friends with people who agree with them. There's not much understanding and dialogue with somebody who doesn't agree with you where you guys can be friends. I'm only friends with you because we both like Apple. The day I stop liking Apple, well, your head's big, I don't like you no more, right? And that's the difference between retail and institutions. I'll have a convo with a colleague or anybody, and we don't agree. But guess what? It's okay, because I learned something from the conversation and I can understand the other side. I still do not have to agree with him, but I can respect why he feels that way about whatever situation it is, and vice versa. And it allows me to grow my knowledge at a faster and a more understanding rate. So I don't think we are, but I think that I can understand somebody who says we are, right? And I think for somebody who started with $10,000, again, for me, paper trade, practice. You don't have to, market's a cycle. You don't have to jump in. There's no, if you could miss this, part of investing is your comfortability. Can you sleep at night? Do you feel comfortable, right? So it's simplistic. You want to take $4,000, $2,000, $3,000 and get a position in a quality ETF that has a nice 10-year return rate, right? Where okay, I put my money in this ETF and I can look and say, okay, over a 10-year period, they have a 20, 15, 10% return rate where I know, okay, I'll be good in 10 years, right? Because it's all a cycle, kind of the same thing. And then learn and then dollar cost average my way in, because the gold isn't the money. The gold is the knowledge, right? And so like people view money as like this anomaly. I need to have this so I can buy material items. And all I can say is that if you love money that much, I can weaponize it against you. So let's say, Mo, that you're infatuated with money. If I give you $5 million today, you'll stop learning and you'll go spend that $5 million. You're now not dangerous to me. I've now taken you out the game because I can buy you out the game. Okay, Mark, here's $10 million. Get out the game. You are now out the game now because your goal was never to learn. Your goal was about money. But the problem is that you can't sustain your money because you never learned anything. So now when you blow that $5 or $10 million, you have to come back to the game and I control the game. So maybe here's another $1 million. Go do that. Right? I think a lot of it is based around, if I'm new, where is my knowledge base? Because the gold is in how you learn. So start off, pick an ETF, right? In that ETF, there's 100, 500, 200, 10, 15 stocks. Pick 4 or 5 of them. Learn those companies. Those companies do well, your ETF does well. It's called the satellite theory, right? So now if I did want to own a stock, I would own the stocks inside the original ETF that I bought. Because if those stocks do well, guess what it does well? My ETF, right? But I didn't buy the ETF with the idea the ETF wouldn't do well. And I didn't buy the ETF without doing my research on the ETF to see what their return rate was for 3, 5, or 10 years. So I understand where they're going and the performance. And I use that same level of research for each individual name. And now I've grown my knowledge base. And now I'm ready to start to inch and take advantage of the market when it gives me good signals, right? Like that's a really simplified process. It might take 2 years. Might take a year. Depends on how much free time and how much focus you put into the craft. But that's respecting the craft. And the people who do that for 20, 30 years, they're not broke. They're not. They're doing well. They can retire. They have, all the houses. Also, it's just about being patient with the process and respecting your craft.
Do you think because of 2020, when it was such a massive anomaly bull run, that so many people have kind of gone away from respecting the craft and it's more about the money than really the knowledge of learning the process of becoming a good investor or even a trader, because it seems like so many people were just, they jumped in head first. I know I did. I know a lot of people did. They just went in. They didn't take that time really to practice and learn the craft. It was like, oh, anything I get in went up, and I'm a genius now.
All right, so you're right. So like, you got kids, right? And it's
Yep.
important. It's important for your oldest kid to set the example, because if your oldest kid doesn't set the example, right, your youngest kid will either say, I want to be like them, or I want to be nothing like them, but you don't control that, right? And so when you get new investors in the market, you get kindergartners mixed with high schoolers. And there could be a D student who's getting D's, but he dresses well, he takes fire Instagram pictures, and they go, I want to be like him when I get to high school. And they don't know that he's a D student. They're just looking at his Instagram and saying, yo, he's fire. I like that, right? The problem with investors is that everybody's commingled. So there's no, okay, all the high schoolers here, all the people here, you get a bunch of people commingled, and you get a bunch of people who are highly influenced. Not by knowledge, not by learning, not by a process, but by material things, by pictures, by posts and different things. And that creates in a vacuum what you saw in 2020. So now that we're back outside, economically, things are a little bit harder. The space doesn't have the energy, the buzz, or the microscope it had, right? So what you're starting to see is people fall by the wayside. Either they lost their money, it got too hard, they never learned because they were following D students the whole time. And now the D student, no disrespect, is working at Walgreens. And it's like, I don't want that life. No, I don't want that. I want to do what, the person I wasn't. We all went to high school, right? There's a person who maybe you say is a nerd. And like, he's laughing now at the guy that was the cool guy in high school, right? Because being cool didn't come with being smart in high school. Being cool came with something else. So I think definitions change over time. So with investors, a lot of kindergartners were easily fooled by D and C students. And now they have to figure out how to re-ingratiate themselves to the A students, because the A student is the guy that's hiring you now, right? So how do I re-ingratiate myself when I lost all my money trading options on higher volatility tech names? How do I re-ingratiate myself when the person that was trying to teach me the process, I was like, nah, man, I'm going to do this. It's going to work. I'm going to day trade. I'm going to swing trade, right? It's not only a hurt to your pockets, but a lot of people's pride are hurt. So it's mental, right? Investing to me is a mental game. It's not really physical. You have to be studying your process. Me and you argue all the time about theses, and you go, Q, I think this, I think that. Again, both things can be true. Both things cannot be true. But I'm steadfast in what I believe in because I've done the work. So I think a lot of times with people, no one did the work in 2020. 98% of stocks went up from April to the end of the year. I could close my eyes and throw darts at names and the stock would have went up 100%. So I think people got caught by marketing, right? That was what it was. Call a spade a spade.
Yeah, it definitely was marketing for a lot of people. And now, because of the bear market, this is when the reality really hit. I would say, honestly, it was probably 2021, mid 2021, people started seeing that it's not as easy as it seemed like in 2020. And people started falling off, and now they're looking at other avenues to try to make a quick buck. And it's unfortunately is sad because I see the views, I see the followers, I see the people interaction, a lot of these financial groups and these people who they used to call goats and all this other stuff. Now it's a lot of stuff you guys called is down 60, 70, 80%. And you look like a dumbass now for following that person.
Well, I think, all right, so like we probably come from the last era where your words had to mean something, right? So I come from like the last era of kids that played outside. And so if I said so-and-so was a big head or whatever it is, when that person came outside, I had to stand on my words. And so the way the internet is, I could be whoever I want. I never have to be held accountable for my words. I can say whatever I want, right? And no one's ever going to hold you, unless you get to a point of celebrity where they'll bring up your old tweets or something like that and you can get canceled. But prior to that, no one has to be responsible for their words. Anybody, even in financial space, right? You have people, even like the people on TV, they'll come on Monday, yo, this is the best stock. Tuesday, it's the worst stock. But I get it though, because information's changed, different things change. So again, like you don't have to be responsible for that. And because there's a lack of responsibility, there's no one there to clean the mess up. And so at the end of the day, that's why it's important if you're brand new to do your due diligence, right? On people, on stocks, on everything. Now, as a New Yorker, I'm naturally skeptical. just because I'm from New York. Like we all are. We're all cynical, skeptical, mean people. We're the nicest mean people you ever meet. I'm the nicest mean person because of where I'm from. Because again, like you'll go somewhere, yo, I got some watches for you. Yo, fam, you're not selling me a Breitling watch for $80. I know it's fake. But a tourist from Iowa is going to buy that watch and think that he just got a $10,000 watch for $80. And he'll get back home, show his friends. And if no one ever tells him, he had the best time in New York. A New Yorker like myself, like, yo, if you don't get the hell out of my face, I'm going to knock you out. Right? Like, I haven't had my coffee yet. You're talking to me. Shut up. And so, like, that's the difference. Therein lies the difference, right? Your passion for the process of wanting to get better at whatever you do. Most people, right, if you think about it, they don't even like their job. So like when you think about like how the process of life goes, okay, in sports, you have majority of average individuals judging above average individuals. So you have Ron is one more late from being fired. Yo, LeBron's trash. Where does that make sense at? So it's the same thing in investing. You got people who are one more late from getting fired, but maybe they know more than you about something, or you think they do because you don't ask any questions. A lot of times when you ask somebody a question who you think is smarter than you, you'll find out they're probably not as smart as smart as you think they are. That's why questions shouldn't be viewed. Now there's no dumb questions, but there's quality questions. If you ask me a question, I can tell if you've done some work on the name rather than if you ask me a dumb question, which I don't think is dumb, but I'll bet you that's a dumb question, right? Because I'm like, yo, you know that I know that you're not doing the work on the name. You want me to give you the answer. So no question is stupid in theory, but it's stupid in the sense of you knew when you asked that you were going to get, you're going to get this response from me, right? Or whatever person you go to for the answer. So I think like when you think about like that, kind of all makes sense. I'm not angry at anybody. I think that that's the space. That's what it's worth.
Very well spoken, Q. I think you got a very different perspective that we don't get to hear much. And just want to recap, you're basically saying that don't use money as a gauge of success, reset and focus on learning. And that should be your goal. Your goal shouldn't be find the next best stock. It should be, how do I improve on my process and then scale it, meaning you can repeat it. That's kind of what the goal is. That's what we do in too.
I mean, listen, Vegas runs on people coming to get rich, right?
Yep.
A few do, a lot don't. And the house always wins. And so the stock market's the same way. Yeah, a few people will get rich. You might go and pull the lever and hit $1 million on the coin machine, or you might go and win some money on blackjack. But how many people lost money for you to win that money? How much did the house intake, right? Like, it's not just about asking questions, but it's about asking quality questions that lead you to answers or directions that people haven't thought about yet, right? But most of the time, what we do, we romanticize ideas or thought processes. Yo, you know what should happen? Apple should buy Peloton, because if Apple buys Peloton, then they could buy Netflix, and then I could watch Netflix while I'm on a Peloton. Right, but like that makes sense. Like, you know me when you're talking. Oh, that'd be dope.
That's a good idea,
bro. You know what that is? That's called position bias. I have Peloton stocks that are down 60%. So,
but like you say that, right? But then you go, okay, look at Apple, a company that has always had strong free cash flow, that never spends their money. So they're not going to wake up on a Tuesday and go, hey, let's buy these two companies that have severe problems within their business lines and revenues, right? And let's go buy them and integrate them in our company, because not, for one, it's gonna hurt our stock, because now we're spending money and we have to prove an idea to be right? They're not going to do that. Not saying they wouldn't do that, but the highly likelihood that they would do that, right, is very low based on who they told us they are. Now, a company can change that over a period of time, but they've told us who they are. They are operational excellence. That's who they are as a company. They are going to give you operational excellence. They're going to give you things that keep you within an ecosystem that may not be best in class, but it's easier to integrate into your life than getting something different. And that keeps you in there. We're going to find different ways to keep you plugged in with sticky products, right? If you have an iPhone, then you have earbuds, then you have an Apple Card, you have all these sticky products. It's impossible to leave, because you would have to leave these sticky products to get. So where in that does that tell me that they want to go into that area? Right. And it's not to say it wouldn't happen, but the likelihood of it. So again, I'm romanticizing rather than to say, hey, I think that they'll be able to grow their revenue because of XYZ. I think that they'll be able to grow their service revenue because of XYZ. I think that they should introduce this, or I think that the Apple Card is innovative because they do this, like parts of their business, as opposed to romanticizing what a company could do, right? And that comes with being realistic. So like at the end of the day, I'm just a realist. Like I don't think that I'm that much smarter than anybody else. I think that I view it from a very realistic perspective. I don't go out and be like, hey man, maybe one day I could date Rihanna. Like that's just never going to happen, right? Let's just be honest. Like that's not something that's in the cards for me or 99.9% of the population of the world. So you know what? It's okay to dream, but romanticizing me sitting here, like, I wonder what our kids' names would be. Like, that's stupid. Like that would just be wasting time. And so people do that all the time within the stock market with stocks. Hey, you know what? If they did this, and it's like, but they're never going to do that. Why would that make sense? And it's frustrating to somebody who's done the work when somebody asks you that, or someone is very strong on, yeah, it's going to happen. Who told you that? Like, do you know somebody? I don't know. Like, so I think those are the things that we have to stop, or at least retail investors have to stop romanticizing and be realists. When you get into a position, what is your downside cutoff? If I have $10,000 is my downside cutoff $1,000? If I'm down 10%, no matter what, I'm out of there. Right? Nobody walks in, no retail investor walks into show, most don't, with a downside idea. Everything's going to the moon.
There's a reason me and Mark talked about it. A lot of content from 2022 now is not based on real shit. It's based on engagement. So if I post top 3 stocks to buy to become a millionaire, 1 million views. Now, if Q posts a video saying, here's my process on how I pick a stock that's people don't want to know the process. Just give me the tickers that are going to take me. And of course, there's no stop losses involved because average down, generational wealth, that's how you build it.
And that's what I'm saying. Tickers have to be high growth ones too. It always has to be these high growth stocks that can 20, 30, 100x in a short period of time.
Yeah, like I've had the combo. Like people go, I'm doubling down. I'm buying more Square or whatever. I'm buying more PayPal. And I'm like, well, why not? Why don't you double down on diversity? Why don't you buy something that trades a little bit opposite of that? That way, if you're wrong, you own a quality name. And if the market as a whole goes up, both stocks will go up, right? I'm not saying but that's not even an idea in your thought process, because again, everybody's thought process is so very much topical, right? And so like I said, because we've all been broke before and we've all figured out how to make a dollar stretch. So, all right, I get paid on Friday. If I do this, I do that. I'm able to get through the week, right? And you're able to like break down everything that you spend money on to figure out how to get to the end of the week to get paid, right? And it's like, well, why not use that same process when you're investing? Like, why not figure out, okay, if I invest in this company, what's the good, what's the downside? Okay, if the downside, okay, I'm comfortable here. Like, it's for the people who really care about knowledge in the process. It's hard to turn the narrative into that because it's easier for people to post rented cars, rented properties, and attract you to material things and money. So like, for example, we got stimulus checks, right? And so part of inflation obviously is what happened, but isn't part of inflation also people taking that money and going shopping? Because designer brands don't make more of an item because it's popular. They just charge more. So the Louis Vuitton bag that was $1,800 before the pandemic and the stimulus checks is now $2,700. The bag isn't made any different. What they saw in the numbers was the demand was higher. Oh, y'all wanted that bag? Cool. Price will increasingly go up. And now you did that as a consumer. The government didn't do that. So-and-so didn't. You did it because you took money, right? Maybe you were shopping. I'm in the house. I'm bored. Whatever it was. Like that's part of the lack of self-reflection as a consumer, to say, you know what, maybe we did that. Maybe part of that's on me. Same thing if I lose a trade. Maybe that's on me. Maybe it's not the stock's fault you lost a trade. Maybe it's your fault. And how many people take accountability when it comes to investing? Most people don't take accountability when it comes to life. So I don't expect you to take accountability when it comes to losing money, because you're in the market in an emotional state. I'm not in an emotional state. I'm in what's real, what's not real. If I lost money, it is what it is. I knew what I was getting into and I got into it. I accept it and I move on. I figure out how in the long term not to get the money back, because the money will come back, but how not to make that mistake again. So many people focus on, all right, I lost 5,000. How can I make 10,000? And all that does is lead you to lose another $5,000 or $10,000 chasing money that you lost. Very few people go, I made that mistake. How do I not do that again? Where was it in my process that mistake was made? So I don't repeat the mistake, because if I don't repeat the mistake, I'll be able to get back that money over a period of time, right? The thought process is a lot different at the institutional level than it is at the retail level because of that.
I think I'm going to get into Palantir in another time, another episode. I'm not going to do this today because I'm going to go on a long tangent. But look at what analysts are saying versus what YouTubers are saying who are not even in that space. Like, again, this is like my opinion. I'm not a big fan of Tesla. I'm a Tesla bear. I think Tesla's going to go down to 550, right? But again, what are the analysts saying? Not what Mark is saying. What are analysts saying?
But to that point, they're going to always be analysts on both sides of the table.
Yeah,
right?
I was going to say
And
that.
All right, let's break down the bear case on Tesla. The bear case being that the cost of lithium is sky high, which then doesn't make it a bad company or a bad car, but it decreases their TAM. Because if they can't build a car that's $20,000, $25,000 and the car is going to be $60,000, $100,000, and I got to wait 6 months to a year to get the car, I can start to understand the bear case, because combustible engine cars are more profitable to turn out than EV cars are. And then on top of that, if I start looking at the overall space of energy or whatever you want to talk about that, all right, 3% of oil and gas use comes from combustible engines. So even if we gave everybody in the world an EV, you still have a 97% use case for oil and gas, right? So you still have containers, ships, you still have airplanes, you still have trucks, you still have trains. So like, it doesn't mean that we just flip this switch and the whole world goes electric, right? You still have a long runway here for combustible engine and different things. So I can understand if someone has a bear case for Tesla. I get it. It makes sense. I can also understand a positive bull case for it, right? And it doesn't mean I have to sit on either side of the aisle. I can literally sit in the middle. You know what? I don't have a strong enough opinion on either side, but I understand both sides. So it allows me to maneuver in the market, right? Because if I believed in Tesla and I'm a perma bull in Tesla, then I wouldn't invest in energy. Because I would think that oil and gas the time is over, it's done, everything is about clean energy, and you would have missed a monumental run from September of last year up until maybe 2 months ago, before it started trading down, where some of the names in refinery and exploration had monumental runs because of the demand and obviously, with all the energy, all the attention in the space, right? So like just that bias, you missed a monumental run because you're biased to the left or to the right. It's okay, I get it. It makes sense. Do I agree? I can understand both sides. Maybe I think I'm probably a little bit more bullish. I wouldn't say I'm like Dan Ives bullish on the name, but I can understand where their position and what the street thinks of them. Because remember, they're not a heavily institutionalized name as far as ownership, right? So a lot of volatility becomes because of retail investors, not because of institutions. But like that's the difference right there, right? I can sit here and break down that, but I don't necessarily have a bare thought process on Tesla, but I understand it. So I'm saying like, that's why I understand it's important.
Now, speaking of the institutional investors, and how much weight do you think a person should put on the institutional investors in the company versus the retail investors in the company? Like typically, for example, I know like Apple, Microsoft, it's a little bit heavier on the institutional side. Not by much, but it is still heavier in there, where versus a company that may have 70% retail investors.
I would always skew to institutional investors. They raise the floor of the stock, right? So like, all right, Apple is always going to have like these $4 up, $4 down. They're not going to swing. Well, why doesn't the stock up 9, 10, 12 bucks move down? Well, because institutional ownership, long-term investors holding the stock, right? It creates a higher floor, which in turn can create a higher ceiling. So like I look at names like Home Depot, good dividend, great management, leverage, right? So like who wouldn't want to own that name at an institutional level, high level institutional ownership, because of all the positive aspects of owning the stock from a short-term, long-term, however you want to slice it. So give me those names, because if I own a stock that's 70% owned by retail investors, that's an emotional stock that's going to trade up and down, and it's not going to trade on facts. It's going to trade on news. It's going to trade on romanticization of thought processes, and then it's going to trade on the actual retail investor need liquidity for whatever you need, whether it's your mortgage, whether it's a new house. So I don't want anything to do with that. that often happens in biotech and biopharma. People view like biotech and biopharma as highly speculative, and it's really not. It's because people put their money in stocks that are $4 that have no cash flow. And it's like you're putting your money in a $5 stock, hoping it goes to $25, that the stock can go to zero, right? Whereas there are names that are highly more liquid because they have proven products or proven processes that you could go to and get exposure in the biotech or biopharma space. And it's not anywhere near as speculative as the sentiment around the area. Like if you go actually look at some of the names that have done well, you're like, oh, wow, that chart looks actually pretty good. Like it's so surprising. But the sentiment around biotech or biopharma is what? It's speculative. It's very volatile. But like healthcare has been a defensive area in the market as far as getting some level of diversity in your portfolio from all the popular stuff that's run up, and then have now come back down. But no one thinks it like that. No one because of sentiment. So you have to be able to have your own thought process because it allows you to take advantage of that. So if you look at like ABBV or Vertex or different names that have done well because they have liquidity, because they have proven processes and proven earnings and a good cash flow in the stocks trade, they don't look like stocks that have been trading in a recession. They look like good, solid companies. And I get myself, and there's even IBB, right? If you're a long-term investor and you don't know what to pick, but you want exposure, IBB as an ETF, like I'm not saying go buy any of these names. What I'm saying is like when you're looking at them, the lens of how you look at a company is very important, or a sector, because it allows you to see opportunities that the masses don't see. And then once the masses lens change to what your lens was, that's where the profitability is.
Good point. So, I mean, I think I don't want to hold you a little bit. I don't want to hold you longer. I think that there's the basics that you just kind of covered. Every investor should look into as well. Another one that I recommend people look into is also the insider selling and buying. I think that's key to also seeing like the sentiment of the company, because if you see a company, you see all the head people who are running the company, CFO, the CEO, people who sit on the board, if they're selling consistently and they're not buying, that should tell you something right there as well. But they don't even believe in the company personally. So that's one of the things to look into as well.
That's the thing, right? So imagine you see a bunch of insiders selling, but then you go on the earnings call and you're like, yeah, it's the best thing ever. And then you go look at the 10K and it's not matching the earnings call in terms of what they're spending. So all three factors have told you information without you having to do an enormous amount of research. That's what I mean by connecting the dots. Like if I look at the 10K and you're saying, hey, we need to spend more money on cybersecurity, and we get on the earnings call and we're like, hey, we need to spend more money on office locations so we can hire more people. And then I go look at insider selling and you're selling the stock off.
Red flags. So red flags. I'll get into this other company some other time. But yeah, that's all I got for questions for you. What about you, Mo?
Nothing, man. I think people need to watch how Q speaks and his thought process around things. Know where he said, buy this, is going to the moon, or like promising stuff. And that's kind of gives you a good idea of how people that are intellectual speak and kind of what their thought process is. I'm glad we brought Q in, and thank you for your time, man.
No, I appreciate you guys. I love talking shop. I would say this, you have to be proud of your process. And that's indicative of the work that you put into you as a person, because the investment is not just opening a Fidelity or a TD Ameritrade or a Schwab account. The investment is you, right? Your health, your mindset, your well-being, your ability to think clearly on a daily basis. Like the investment is us. And if you're not investing yourself, but you're investing everything in the market, you're still not really investing. And I think that's just the difference. Like my investment is to me and myself. And the market, I do well in the market, or I'm good at the market because I invest in me. I'm not investing in myself because I invest in the market, or I'm not good at being me because I invest in the market. I'm good at the market because I invest in me. And that's the most important thing I can leave with.
Awesome. Thank you, Q. Where can they find you on social?
I'm terrible at this. Mr. Wall Street. I don't know if you could put my thing up. It's M. Was it M? I should gotta spell it regular Mr. _ Wall Street. I'm terrible.
I'll put it up. I'll put it up. I'll put it up. He doesn't even know his own handle.
Yeah, I don't take myself seriously. QMart32 on Twitter, I think. Or just I think that's what it is. I'm like the most non-serious person. I probably should work on that, but
I'll put his social in the description below, everybody. So again, everyone, thank you for stopping by. Mo, where can they find you?
OTB Clubhouse.
Yeah, and you guys know you can find me on YouTube at Trading with a Dummy. Of course, on my IGs is Trading with a Dummy as well. Once again, Q, thank you so much for coming on. Everybody, we'll see you next week.